Silver's recent sell-off sparked debate because timing aligned closely with futures market structural adjustments. Understanding whether CME margin hikes forced selling requires examining real mechanics, not speculation. Silver pricing occurs primarily through futures contracts rather than immediate physical exchange activity. Futures markets embed leverage, allowing large exposure with relatively small upfront capital commitments. When volatility increases, exchanges adjust margin requirements to protect clearing system integrity. The Chicago Mercantile Exchange applies margin changes based on measured risk and price variability. These margin adjustments are rule-based, not discretionary opinions about future price direction. When margins rise, traders must post additional collateral to maintain existing leverage positions. If sufficient collateral is unavailable, positions are reduced or liquidated automatically. This selling occurs regardless of bullish or bearish sentiment among participants. Historically, silver reacts sharply to margin changes due to its comparatively smaller futures depth. Relative to gold, silver's futures market absorbs forced selling less smoothly. During periods of rising volatility, leverage becomes increasingly expensive to sustain. This expense pressures traders holding large long positions during unstable price conditions. In the weeks preceding the sell-off, silver volatility had already begun increasing. At the same time, futures open interest remained elevated, indicating heavy leverage participation. Price momentum stalled, creating vulnerability. Once risk controls tightened further, margin hikes typically follow volatility rather than precede it. In most cases, therefore, margin increases often arrive when markets are already stressed. When imposed during such stress, they can accelerate existing downside pressure. This acceleration feels sudden because margin calls operate within strict timeframes. Traders facing margin calls must act quickly to meet requirements or exit, as multiple participants reduce positions simultaneously. Liquidity thins rapidly. Thin. Liquidity magnifies price moves even without large absolute selling volume. This mechanism explains why silver sell-offs appear disproportionate relative to news flow. No fundamental demand collapse is required for price to fall sharply. Instead, price adjusts to levels where remaining participants can afford exposure. This process is mechanical, driven by clearing rules and capital constraints. Silver's industrial demand does not immediately stabilize futures-driven sell-offs. Industrial buyers hedge gradually and do not absorb sudden futures liquidation. Therefore, futures markets temporarily lack natural buyers during forced selling events. This absence allows prices to gap lower until balance is restored past silver sell-offs. Following margin hikes demonstrate similar rapid repricing patterns. Those episodes were later understood as leverage resets rather than demand failures. The current sell-off shares these structural characteristics closely. CME margin hikes alone do not create sell-offs without pre-existing stress. They act as catalysts when leverage and volatility are already elevated. This distinction is crucial for accurate interpretation of market behavior. Blaming margin hikes exclusively ignores underlying conditions that made markets fragile. Silver became fragile because leverage accumulated during extended periods of stability. Stability suppresses volatility, encouraging greater position size across participants. Once volatility returns, risk models force reductions across many accounts. These reductions occur simultaneously, amplifying downward momentum significantly. Because rules are uniform, responses become synchronized across market participants. Synchronization produces clean, decisive moves rather than chaotic price action. Such moves often feel scripted because outcomes follow predictable constraints. Predictability does not imply manipulation, but reflects structural inevitability. The timing aligns because constraints were reached at that precise moment. Data shows margin hikes coincided closely with accelerated silver price declines. Charts comparing margin change dates with intraday price action support. This additionally open interest declined sharply, following the sell-off indicating deleveraging. Deleveraging confirms forced position reduction rather than discretionary selling. After forced selling, volatility often subsides as leverage resets lower. Prices may stabilize once remaining participants can sustain positions comfortably. This stabilization should not be mistaken for immediate bullish reversal. It represents equilibrium after stress rather than renewed confidence. Future direction depends on liquidity conditions, interest rates, and volatility trends. If liquidity improves, leverage can rebuild and price may recover gradually. If stress persists further, forced adjustments may occur again. Therefore, margin hikes matter because they expose hidden leverage during stress. They do not dictate long-term value, but influence short-term price dynamics. Understanding this helps avoid misinterpreting mechanical sell-offs as sentiment shifts. Silver's sell-off fits historical patterns observed during prior margin-driven events. Evidence supports margin hikes acting as accelerants within stressed conditions. They forced selling because leverage had already reached unsustainable levels. This explanation relies on observable data, not speculative assumptions. Recognizing these mechanics improves analysis of future silver price movements. After the initial sell-off, attention shifted toward what happens following margin-driven resets. Post-sell-off behavior often reveals whether moves were temporary resets or deeper trends. In silver markets, history shows margin-induced sell-offs frequently stabilize before directional continuation. Stabilization occurs because forced liquidation removes excess leverage from the system rapidly globally. Once leverage resets, remaining participants face lower margin pressure and volatility sensitivity levels. This creates a calmer trading environment, even if macro conditions remain unchanged externally. Such calm often misleads observers into assuming worst risks have fully passed already. However, post-margin, reset phases frequently carry heightened vulnerability to renewed shocks later. Why vulnerability persists relates to liquidity conditions rather than price direction alone globally. Liquidity rarely improves immediately after deleveraging, especially under restrictive monetary policy environments worldwide. Elevated interest rates continue increasing opportunity costs for holding non-yielding assets globally. Today, silver therefore remains sensitive to funding stress despite recent price stabilization phases globally. Another post-sell-off signal involves futures open interest behavior following liquidation events closely. Declining open interest confirms positions exited rather than transferred to new holders elsewhere. This reduction often reduces volatility temporarily by shrinking speculative participation across markets globally. Lower volatility does not guarantee upside momentum without supportive liquidity. Inflows returning soon, rebounds following margin sell-offs frequently occur but tend to be fragile under stress. Fragility reflects absence of new leverage rather than lack of bullish sentiment alone. Without leverage, price advances rely on physical demand and incremental positioning flows only. Physical silver demand moves slowly and cannot counter rapid futures liquidation events alone. This structural mismatch explains why futures-driven declines often overshoot fundamentals, temporarily globally. Overshooting resets price to levels compatible with reduced leverage tolerance across participants, system-wide. Following resets, participants reassess risk exposure using updated volatility assumptions, models, and limits. These reassessments often constrain position sizes for extended periods afterward across markets globally. Consequently, silver markets may enter consolidation rather than immediate trend continuation phases again. Consolidation frustrates traders expecting swift recoveries after sharp sell-offs during stress reset cycles. Understanding this dynamic helps avoid premature conclusions about market direction following forced events. Another factor to consider involves regulatory communication and exchange transparency. During volatile periods, margin hikes are publicly disclosed, yet their implications remain misunderstood by many participants. Many interpret margin changes as bearish signals rather than protective measures for systems. This misinterpretation fuels emotional responses rather than structured risk management decisions during stress. Educational clarity around margins helps contextualize silver volatility rationally within futures market mechanics. Beyond margins, broader macro variables continue shaping silver behavior post-sell-off phases globally. Dollar strength funding availability and rate expectations remain critical drivers for metals prices. If dollar liquidity tightens, further silver remains vulnerable to renewed pressure during adjustments. Conversely, easing liquidity conditions could support gradual silver price recovery over time horizons. Therefore, post-sell-off analysis should focus on liquidity metrics rather than emotions alone. Metrics include funding spreads, repo conditions, and futures market depth across exchanges globally. Tracking these indicators provides early warnings of potential renewed instability within silver markets. Historical evidence shows silver often signals liquidity stress before other assets react fully. This signaling role explains why silver moves attract disproportionate attention during market transitions. Market transitions involve regime shifts where prior assumptions lose validity under new conditions. During transitions, forced repricing events act as informational resets for participants system-wide globally. These resets realign expectations with actual risk-carrying capacity across markets today globally. Silver's sell-off therefore served as a reset rather than breakdown of market function. Recognizing resets helps investors avoid misclassifying events as catastrophic systemic failures alone globally. Catastrophic failures display persistent disorder. Unlike structured margin-driven repricing episodes observed here, evidence from price behavior, volatility, and positioning supports mechanical explanation for this event. This explanation aligns with documented futures, market responses to margin changes historically observed. Thus, credible analysis favors structural causation over speculative narratives regarding silver's sell-off timing. Going forward, monitoring exchange margin policies remains essential for silver traders and analysts. Awareness of margin sensitivity allows better preparation for volatility events within futures markets. Preparation does not prevent losses, but improves timing and risk control strategies significantly. Investors ignoring structure risk, repeating surprise during future liquidity shifts within silver markets. Those respecting structure respond earlier with measured adjustments, rather than panic selling behavior. Silver's margin-driven sell-off thus provides a valuable learning case for market participants. Learning cases improve collective understanding of how modern markets function under stress conditions. Such understanding reduces tendency to personalize or sensationalize market moves during volatile periods. Reducing sensationalism improves discourse quality and decision-making, accuracy among investors globally today. Ultimately, silver reflects system pressures rather than individual actor intentions during stress events. Recognizing this distinction supports rational analysis during future silver volatility episodes across cycles. This concludes examination of post-sell-off dynamics following CME margin adjustments within silver. Further insights emerge when comparing silver responses across multiple historical margin events globally. Across decades, similar patterns recur regardless of broader economic narratives present at times. Patterns include volatility, spikes, open interest drops, and temporary price overshoots following hikes. These features collectively define margin-induced adjustment episodes in commodities, markets worldwide. Today, silver exhibits them more dramatically due leverage intensity and liquidity. Characteristics combined together. Understanding relative intensity helps contextualize silver moves versus gold during stress periods. Globally, gold's deeper liquidity buffers absorb margin shocks more smoothly historically than silver markets. Therefore, silver often leads metals repricing during tightening liquidity regimes across markets globally. Leading does not imply causation, but sensitivity to shared constraints within future systems. This sensitivity makes silver valuable indicator for broader market stress monitoring efforts worldwide. Analysts frequently watch silver during policy shifts for early signals of liquidity strain. The recent sell-off reaffirmed silver's signaling role under margin pressure conditions globally today. As markets evolve, margin frameworks will continue shaping short-term behavior within commodities. Participants ignoring these frameworks risk misreading future volatility episodes across silver markets. Again, thus, education around margins should be central to metals market analysis efforts globally. With this context, viewers can better interpret subsequent silver price movements without overreaction. The evidence indicates CME margin hikes amplified rather than invented, selling pressure mechanically. This amplification explains timing, precision observed during the silver sell-off event under review. If you found this break